Howdy friends, we got 6 financial moves that anybody can be making now, particularly if you've lost your job. And certainly that's the case of so many Americans. So we thought we would dedicate some time on the program to talk about some things that those folks can do, perhaps to kind of get over this hump that is this pandemic that has certainly cost a tremendous amount of people their jobs. Plus, we'll talk about some tax traps to be aware of, particularly if you're trying to access cash during a period of time where you might have lost your job, along with some of the tax traps that exist at any age, no matter the scenario. So we'll cover all of those topics here on the program. Of course, this is Dollars and Cents. We are Central Florida's longest running radio program, and now approaching well over 30 years on air. Started all those many years ago by my late father-in-law, Jack Nelson, continued today by me, yours truly, Joel Garris of Nelson Financial Planning. We also have this format on the internet in the form of a variety of podcasts and, of course, our YouTube video as well over on our channel there at Nelson Financial Planning. So recently named one of the top 25 financial planning podcasts on the World Wide Web, thanks to the folks at FeedSpot. So we're certainly excited about that accolade and glad you've joined us, whether it's on air on WFLA Orlando or if it is through the magic of the internet. So before we dig into all of that, I wanted to just kind of give a addendum to the story we were talking about a couple of weeks ago. As you know, we wound up getting a stimulus check here in the office for somebody that had already passed away, and from time to time we get the privilege and the honor to help people serve as personal executors or those kinds of things of their estate. And so this particular check came to us by virtue of an estate that we had helped close out. And as we were showing you on the video and certainly talking about it on radio, the check itself had the person's name, and then after it was the initials DECD, which obviously stands for deceased. So the IRS had literally issued out a check to a person that they knew was deceased because it was on the check itself. Well, as you might not be completely surprised, certainly we aren't, the IRS has now issued some guidance on what to do with those checks. And so not only did we get that check in the office, but we actually had a couple of different situations where surviving spouses got a check for their spouse that had passed away in the previous year. And so obviously the IRS issued some guidance out. So in our case, where we got the physical check, we're going to actually have to return that, which I kind of don't want to, because I like the notion of just having it around to kind of see share and show the kind of the silliness that is the IRS. But they don't really want me to have that. If I get a paper check, I have to send it back. So we will be marking that with void and sending that back to them. If you wound up getting a deposit that you should not have gotten, particularly in the case of someone that has passed away, then you will need to write a check. They'll take a personal check, thank you very much, but please make sure it's made payable to the United States Treasury and send that money back. That is now the official word out of the IRS. We thought we would give you the latest on that, given that we kind of had a little bit of a conversation about checks going to dead people. IRS has said, wait a minute, those we want back. So if you got that, you're going to have to write a check, send it back. If you still have the physical check, then we're going to have to mark void and mail it back to them. So thought we would just give a little addendum to the story of a couple of weeks ago in terms of those stimulus checks. We hope by now you've gotten your check. It's certainly been a moving target, that is for sure, but I know there are certainly some that haven't gotten their check that should be deserving of it. at this point, you're probably in a wait and see kind of situation. So just continue to be patient on that, and hopefully it will show up eventually. So anyway, as we're talking about on the top of the program, obviously the coronavirus pandemic has really hit so many people. I mean, the numbers are just staggering when you look at the number of people that are out of work these days. And so, like most, you may be kind of thinking about, well, the income's not coming in, so how, in fact, do I sort of get through this? And ideally, that's where an emergency savings type of account would certainly come in handy. Of course, we all live in the real world and know that not many people have an emergency savings account. So we kind of have to get down to the reality of, okay, what are some of the strategies that you can do to help yourself during the course of this pandemic, particularly for those that have lost their job. So we're going to give you kind of 6 different strategies to really kind of consider and really work through. And the first strategy comes down to understanding the difference between needs versus wants, right? Those sort of sound the same, but they're really not. Your needs are kind of your fixed expenses that you've got to certainly cover and pay for. Maybe that's your mortgage or your cell phone bill or your car payment. Those are sort of those needs, those fixed expenses. The wants is sort of everything else, right? The wants are going out to dinner, although you can't really do that much these days, but restaurants are starting to reopen. So those types of more discretionary items, and to really start to draw that line between what's a need, what do I have to do, what do I have to pay, versus kind of the optional types of things. And so it really it is incumbent upon folks to really survey their spending and to try and categorize how they're spending their dollars on things on a regular basis. Obviously, a trip to Starbucks and $5 coffee is a discretionary, a want item versus paying your car payment. So really to take stock of surveying your spending and really trying to categorize those needs versus wants, that's probably the number one thing you can do if you're faced with the situation like so many Americans these days that they don't have that income coming in anymore. So that's certainly number one. Number two, sort of along that same lines, once you've sort of surveyed your spending, you kind of get a handle on it, then it becomes a situation of, okay, well, how can I perhaps improve some of those things that I have to spend money on? How can I sort of improve what I'm spending that money on? In other words, reduce the amount that I'm spending. So maybe it's the cell phone bill, maybe it's the internet bill, maybe it's a recurring subscription, maybe it's a gym membership. Those types of things, while they might be kind of on the borderline between it's a need versus a want, certainly you may find that if you readjust what you're doing, go to a different cell phone plan, or in the case of your automobile insurance, go to maybe something that might have a little bit higher deductible for the time being. Those are ways in which to reduce down those expenses. So the notion of negotiating and trying to find a better deal or a better cost is certainly first and foremost in terms of trying to help yourself during this period of time, particularly if you've lost your job. And for that matter, mortgage companies or other lenders or car companies or credit card companies will be more in the mode of being able to adjust if you have the conversation with them to try and renegotiate those kinds of more set or fixed expenses. Similarly, next up on the list would be sort of reconsidering your tax withholding, right? So let's say your paycheck has been reduced. Maybe you haven't completely lost your paycheck, but it's been reduced. Maybe you've been put on a part-time basis. One of the tricks that you could do is adjust your tax withholding so that you are getting more of your paycheck rather than sending a chunk off to the IRS. Now be careful on that, because you still owe the taxes. So you don't want to take it all the way down to nothing, because then you're going to have a problem next April. But the reality is that you might, for a period of time, adjust your tax withholding and ultimately get a little bit more money in your pocket. Particularly, say for example, if you have had your hours reduced, or maybe your spouse has lost their job. If that's the case, then obviously your overall income picture for this year is going to be less. So that means your taxes are going to be less. So you really may be able to adjust the tax withholding a bit more on that. So those are some of the concepts that we want to get out to you, particularly if you're looking to try and figure out how to manage your finances and address things if you've lost your job. We got a few more items that we want to kind of share with you as well, some strategies, if you will. We got a total of 6 of them. We just covered 3. When we get back from the break, we'll cover the next 3 here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando. Howdy friends, Joel Garris here of Nelson Financial Planning. You're listening to Dollars and Cents, where we help you make sense out of all those different decisions that have anything and everything to do with your dollars. This segment of the program, we're sort of working through some of the things that folks can do if they've lost their job. And we've boiled it down to sort of 6 different things that folks need to be thinking about and focusing on to help themselves financially if they're in that situation where this pandemic has affected their paycheck. And before the break, we talked about the first 3 on the list. And of course, it's simply understanding the difference between needs versus wants, really reflecting on your spending and determining those things that you have to pay versus those things that maybe you don't need to have right now. So really, it starts with number 1, sort of surveying your spending. And then, the second point that we would make is to really try, once you've kind of surveyed the spending and kind of got a lay of the land on that, to really try and negotiate, not just with your lenders, your mortgage company or your car payment or your credit card companies, but to also think about negotiating everything else, right? I mean, there is a process where during this pandemic that you can go through the process of suspending your mortgage payments. That's something obviously you want to talk to your lender directly on in order to make sure that that happens if you need to do that. But we're also thinking about your cell phone bill or your internet bill or those kinds of things that you have on a regular basis that perhaps you can adjust what you're doing or what you're having in terms of the options on that. And then that way that would save you some money. And then the third option is, just to kind of think about your tax withholding that you're doing. Maybe your job has been reduced down to part-time. Maybe your spouse has lost their job. One of the things that you could do is adjust your tax withholding so that you get more of your paycheck, because obviously you need that money to pay the bills. Beware, not a perfect solution on that, because eventually you'll still have to pay the taxes on it. But if you've got a lower income, or maybe your spouse has lost their job, then obviously your income picture for this year will be less, and so consequently your tax bill will be less as well. So those are the first 3 things to be thinking about. And so here are the other 3 to kind of consider. And it boils down to kind of looking at your insurance, and not just your health insurance, but also your auto insurance, just your insurances in general. Those are the kinds of things that come in on a regular basis that you have to pay. Is there some room to maybe adjust what you're doing there? Maybe get a higher deductible, maybe adjust the amount that you're paying in terms of those premiums. Because anytime you adjust your deductible, then you would find that your premium would go down if you increase your deductible. So certainly looking at insurance and ways that you can kind of adjust the cost there. And then, certainly on this list has to be getting the rest of the crew on board, right? So as a family, maybe you've got a spouse or children still at the house, and you need to get everybody on board. This is a conversation that if you've lost your job, you've got to start having around the dinner table as to what are some of the ways in which that we can, as a family, reduce the expenses. Maybe not order that pizza out, maybe not swing through the Chick-fil-A drive-through, but really sort of circle the wagons, and ultimately as a family to make sure that we're spending, our spending is cut to reflect the fact that our income has also been cut. So again, so important to talk to everybody in the family to make sure to try and get everybody on board as well. And then lastly, to the extent that you have one, certainly you want to tap your emergency fund. It's so funny, we've certainly had many conversations over the course of the past several weeks, and it's always amazing when people say, well, I don't want to tap my emergency fund. And I'm like, well, this would be an emergency. I mean, there's no question this would be an emergency. So if you're not going to tap your emergency fund under these set of circumstances, what circumstances are you looking for to tap your emergency fund? Folks, if you've got an emergency fund, this is exactly the kind of scenario of why you have that. So don't hesitate to tap that emergency fund. And it's funny, the psychology of people, if they have that emergency fund, they're like, they don't really want to dip into it no matter what. But this is exactly the kind of scenario where you would say, hey, got to dip into that and certainly have to use it. That, after all, is what it's all about. So I'm reminded of a conversation I had, with a client who plays in an orchestra, and the orchestra, obviously they got furloughed, but they've got a huge endowment and a huge emergency fund, and for whatever reason they're like, well, we're not going to touch that. That's for emergencies. And again, I'm thinking this is the emergency. So make sure you also be sure and tap that if you've got it, and not just say, I'm not going to do that. That's what it's there for. So again, to recap, the 6 things that you can do to try and sort of get through this period of time if you're one of the many unfortunate folks that have lost their job or been furloughed. It starts with surveying your spending, understanding the difference between needs versus wants, compartmentalizing those fixed expenses with those discretionary expenses. Number 2, it starts with kind of negotiating what you're paying, negotiating with your lender, but also your service providers, whether that be like your cable company or your gym membership or whatever the case may be. And then, number 3 on the list is reconsider sort of the tax withholding. If you adjust your tax withholding, that means you're going to get more money in your pocket. If you've lost your job, or your spouse has lost their job, or you've had your hours reduced, your income is going to be less this year, so your tax bill is also going to be less. So you can probably play around with your tax withholding a little bit to get more of that money coming to you. And then number 4, kind of look at the insurance, particularly the auto insurance. Higher deductible typically means a lower premium, so maybe there's some savings there. Shoot, maybe you're not driving as much, right? If you're not going into work, you're not driving as much, there may be some discounts that you might be able to realize on your insurance there. And then make sure, number 5, that the family is on board, right? We're all in this together. And so it's so important to have that conversation with the family. The kids should not be running out to the drive-thru at Chick-fil-A or ordering pizza if you're in a situation where the income is not coming in. Got to get the family on board, and so to have that family conversation. And then tap the emergency fund. If you've got an emergency fund, now's the time to use it. And look at the tax implications. We're actually going to talk about that a little bit later in the program, but now is the perfect time to tap the emergency fund. No question at all about that. That's, after all, what it is there for. So certainly some 6 valuable things to be thinking about if you've lost your job, trying to figure out, okay, what do I do with my finances? So be sure to work through all of those in a way to try and help yourself during this tough time. So we'll slide to a break. When we get back from the break, we're going to talk about some of the different tax traps that exist no matter what, no matter what's going on in the economy, no matter what's going on with the pandemic, there are certainly some tax traps that exist at any age, no matter what, that it's important to be aware of and to be working through or be aware of as you go through those different ages. There's a bunch of different tax traps at different ages, so we want to kind of go through the list on that, particularly the more impactful ones. So stay tuned through the break. When we get back, we'll continue here on Dollars and Cents with Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. Welcome back, ladies and gentlemen. This is Dollars and Cents with your host, Joel Garris of Nelson Financial Planning on News Radio WFLA. This segment of the program, we're going to talk about some of those tax traps that exist no matter what at pretty much every age. Every age, if you think of it, sort of has a little bit of a different tax trap. We're going to hit some of the more popular ones that spring up at different ages so that you're aware of them, particularly if maybe you've got a birthday coming up or something like that. I've got a birthday coming up here in a week or so. So in one of these ages, and I'll let you guess which one it is, has an additional tax trap that comes with it. So let's begin. We'll start with the kids. So clearly we're not in that age group. The kiddie tax applies for children, infants, newborns, on up to age 23. And what the kiddie tax is it basically is a mechanism where the IRS does not like it when parents or grandparents try to push income onto a kid's return, thinking that that kid's return is going to be a lower tax rate than theirs. So specifically, the kiddie tax was invented to make sure that that does not happen. And what it is it hits unearned income. So think investment income, dividends, capital gains, interest, things like that. It hits unearned income up until age 24. So between 0 through age 23 up to age 24, you are basically that income, to the extent that that unearned income is over $2,200, that income then is taxed at the parent's highest marginal tax rate. So kiddie tax, obviously very unique. It applies to typically investment income, unearned income. It's not going to apply to the kid's summer job, assuming they can find one this summer. The reality is that that really relates to unearned income or more investment income. So designed to make sure that that income still gets taxed just like it would appear on the parent's rate. Big change of late, the prior couple of years, the estate tax rates have applied. This year we're back to kind of that traditional format of the kiddie tax where it's the highest marginal rate that is on the parent's tax return. So that one's kind of had a little bit of a flip over to estate tax rates for a period of time in the past couple of years, and then flip back to sort of the way that it was. Bottom line, if it's unearned income and it's a kid, they're going to have to pay it at a much higher rate than if it was just their income on their own return. So that's important to know. The next sort of age group is either the 18 or the 21-year-olds. 18 here in Florida. It depends on what state you're in as to whether it's 18 or 21, but generally in Florida, age of majority is 18. That means on a custodial account, meaning a minor's account or something like that, that was set up for the benefit of a child, that money automatically becomes theirs. And in fact, the state law recognizes it such that if you are the parent and you set up a minor's account, the second that kid turns 18 here in Florida, you no longer have any say whatsoever on the account. You can't move it, you can't take money out, you can't even readjust the investment allocation of it. That's how stringent the law is, or the tax trap is, at 18 on a minor's account. The kid turns 18, it's automatically theirs, no matter what. So be aware of that you no longer get the say in that account, at least from a legal point of view. Next age up would be 30. And I haven't quite hit my birth age yet, given my birthday coming up next week. 30, okay, is a Coverdell Educational Savings Account. If you own a Coverdell Educational Savings Account, which is a type of account that you could set up to help fund college expenses, guess what? Within 30 days of turning age 30, all of the money must be distributed out of that account. If it's not used for education, it is taxable with a penalty. So understand that if you've got an old educational savings account laying around, or maybe the kids have one and they just didn't use all of it, on an educational savings account, you have to have taken the money out 30 days before your age 30. Different from a 529 or other types of college savings types of vehicles, but a Coverdell Educational Savings Account has a specific tax trap in it that springs up at age 30, that if you don't take the money, then you've got to take the money before you turn age 30. Next age up, age 50. Age 50, that's when you can start to put more money into your retirement account. So if it's a 401k, 403b, deferred comp, you get to put an extra $6,500 in on top of the normal contribution for the year 2020. If it's a simple, it's $3,000. If it's an IRA or a Roth, it's an extra $1,000 that you can contribute. So for the example of an IRA or Roth, where the contribution limit is $6,000, once you turn age 50, you could do an extra $1,000 on top of that, and ultimately be a total of $7,000 into that IRA or into that Roth. So next up, 55. So at 55, age 55, the tax trap there is that if you retire, you can get access to your employer-sponsored retirement plan without a 10% penalty for early distribution, but only if you're taking the money out of said employer retirement plan. If you take the 401k or 403b or whatever it is and roll it over to an IRA, that tax trap will spring up and bite you, because it only applies to a qualified retirement plan if you're retiring over the age of 55, or in the year in which you turn age 55 is the technical rule. Then you can get money out of that retirement account and not have to worry about a 10% penalty. That's very unique on a qualified retirement plan provided by an employer. Doesn't apply on an IRA, so beware of that tax trap. 59 and a half, of course, next age up is the age where you would have no penalty on being able to take money out of a retirement account, no matter what type of retirement account it is. Next up, 62. That's the age where you can take your Social Security early. It's obviously subject to reduced benefits, but at 62 is the earliest age in which you can take your Social Security. 65 would be the next stage. Why is that important? Well, that's where you get eligible for Medicare. And certainly if you've had to pay for your own health insurance, you know 65 Medicare, there's definitely a price savings or a cost savings in going and getting on Medicare versus being having your own policy, particularly if you're in your early 60s. Full retirement age under Social Security, age 67. That's the age where you would not be subject to any reduction whatsoever. Similarly, age 70 is if the maximum age that you can postpone your Social Security until, in order to maximize out your benefits. Now, the last age we'll throw out there, your required minimum distribution. Used to be 70 and a half. Now it's 72. Of course, this year's kind of all tossed up in the air because it has the required minimum distribution has been suspended for this year, but going forward the required minimum distribution age is going to be 72. So lots of different ages there, starting all the way from 0 all the way up to 72 in terms of some different tax implications, or really tax traps. If you aren't aware of these ages and what kicks in at certain ages, then you may very well find yourself paying more in taxes, or perhaps not saving as much on taxes as you might otherwise have had the opportunity to do. So just be aware, a lot of tax traps out there. No matter your age, there's always something that might be lurking out there. So we just kind of covered some of the basic ages and some of the basic tax traps that exist. But interesting to note, no matter how old you are, there's always a little bit of a trap from the IRS. So beware of that, particularly as you turn these ages, right? Then you may want to adjust your planning for those changes in ages as well. So we're going to take a break. During the break, we'll listen to some messages from various people, including one of our ads. So that's always a good thing. And then when we get back, we will continue the conversation. When we get back, we're going to talk about kind of stay on this tax topic and talk about some of the tax pitfalls to be aware of if you're trying to access money in today's world. So stay tuned for that here on the program. This is Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando. Welcome back, friends. Joel Garris here of Nelson Financial Planning, News Radio, WFLA. This is Dollars and Cents. Talking in the last segment about some tax traps that exist at different ages that you need to be aware of. We thought on this segment of the program, we would actually talk about some of the tax implications you need to be aware of if you're having to access money. Earlier in the program, we talked about the 6 things that folks need to be doing if they've seen their hours reduced or have seen somebody in their house lose their job as a result of this pandemic. And the other feature, of course, to be aware of is sort of what the tax implications might be depending upon what you're trying to access to maybe bridge the gap financially. So we thought we would sort of combine the conversation from the second segment and the third segment here in this last segment to kind of go through some of the things to be aware of in terms of what your options are to access money, particularly if you need it during this terrible crisis based upon the pandemic. So one of the things that is new this year is the ability to access IRA money. And no matter how old you are, you can actually avoid the 10% penalty on that if you are accessing it because you've been affected by COVID. Now, the guidance from the IRS isn't terribly specific on this in terms of what affected by COVID means, but generally they want to see a direct effect. And so if you can prove that, then you can take up to $100,000 out of a retirement account, and regardless of how old you are, not have to worry about paying what would otherwise be a 10% penalty for early distribution. So that's a good feature. Remember though, you still got to pay taxes on it. And so though the benefit though with what the CARES Act provided is that it allowed you to spread out those taxes over a 3-year period of time, and also to be able to repay that within that 3-year period of time. So a lot of flexibility in terms of being able to access retirement. Clearly the folks in Congress knew with the massive unemployment that would occur as a result of shutting down the economy that there's going to be a number of folks that have to access their retirement because they just need the money and that's the only place they've got. And so consequently, these newer provisions allow for the longer period of time in which you can pay it back and the ability to avoid what would traditionally be an additional 10% penalty on top of that. So definitely you've got some tax things to consider if you look at taking money out of the IRA. Similarly, and I think most people sort of forget that, let's say you've gone through the system and have been able to actually start collecting unemployment. Understand that unemployment is taxable. Just like a paycheck is taxable, your unemployment benefits are taxable. So just be aware that as you're receiving the unemployment, that ultimately you're going to have to add that into your total income for the year 2020. Another option is to look at perhaps doing a loan on your 401k. Now, the benefit of a loan on a 401k is that it doesn't trigger any taxation as you use that money, and so that actually becomes almost like a tax-free way to access money. The problem becomes if you kind of lose your job permanently. And if you lose your job permanently, then what happens most of the time is that 401k loans are then treated as distributions. So that means then that now you've got that income that you borrowed, thinking that you were going to borrow it without having to worry about any taxes. Now you have to pay taxes on that. So just be aware, 401k loan certainly looks good on the surface, and assuming you stay employed, that's a great option if you need access to money and don't have any other source, because you can get the 401k loan and not have to worry about it being taxable. But if you lose the job, then typically the 401k loan winds up being treated as a distribution. So that's certainly something to be aware of. Another option, of course, is the traditional home, right? I mean, if you have some equity in your home, may be able to get a home equity line. Similarly, a home equity line is money that can come to you, and there's no tax implications or anything like that on it. But understand that the interest is not nearly as deductible as it used to be, for a couple of different reasons. Number one, with the much larger standard deduction, then you don't have that many people that are itemizing their various expenses like they used to. It's like under 10% of the people out there now itemize, whereby they would be getting a separate write-off on any interest that they paid. Combined with the fact that the rules have sort of changed on your ability to deduct the interest that you pay on a home equity line anyway, where you can't really deduct that interest. But obviously, if you can do a home equity line or get cash out of your house, then that is money that you can get without having any tax implications. So certainly got some options here between 401k loan, between maybe trying to tap the equity of your house. I mean, obviously, difficult times like this, there aren't perfect answers. These are not easy answers by any stretch of the imagination, but they're at least options that might not create as big a tax implication for you should you choose to explore that versus taking money out of your IRA or something like that. There's a few other things to think about as well. If you've got a regular investment account, obviously that's much better than taking money out of a retirement account. Regular investment account, generally you'll be able to use that money at dividend or capital gain tax rates, which are obviously taxed at much less of a rate than income tax brackets. So regular investment account, that is a great option to use, almost like an emergency savings account. The only real tax implications there are interest, dividends, and any gain on it. Similarly, a college savings account, I mean, again, if we're in a pretty unique set of circumstances, which obviously nowadays we are, if you needed to access money using a college savings account, the withdrawal, the earnings of portion of that withdrawal would be taxable plus a 10% penalty, but the portion that represents your contributions would be not taxable at all. Because see, when you fund a college savings account, you don't get a tax deduction for it, you don't get any tax savings on it. So the contributions that you put in, that portion of it will always carry no tax implications on it as well. Earnings are still going to be taxable as income plus a 10% penalty. But again, if you're looking for money, you need money, no other place to get it. Certainly a college savings plan does have some features to accessing that money. Even though it's not used for educational purposes, you still would wind up having a little bit better tax implications if you were using that money. And then, certainly to add into the mix, let's say you own individual stocks, or maybe you own mutual funds in a brokerage account, you could borrow against that. That's the notion of doing a margin loan against that on a traditional kind of brokerage account, where you have the ability to borrow money against your investments. It can't be a retirement account, mind you. It has to be after tax money. A margin loan is fraught with risk, particularly in a market that is as volatile as what we've seen. So I would be very hesitant to go that route. The beauty of that route, though, or the one benefit to that route, is that it would come to you without any taxes. But again, market volatility being what it is, you may be forced into sell if there's a market decline. So really kind of want to use that one again as an option of last resort. I might just go ahead and use some of that money out of that account rather than borrow against it. So as you can see, there's a lot of different options that if you needed money, you could access it, but just be aware that the difference in taxes may really drive a better location than others in terms of accessing that money. So certainly something to think about if you do need to get a hold of money during this period of time. So anyway, we will wrap it on up and get on out of here. Thank you all for listening to the program. We'll be back next week as we always are. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning on News Radio, WFLA, Orlando.